Michael Burry made correct predictions. The biggest collapse in decades has begun. Even a graph looks sick. This catastrophe is just the beginning of something much worse. Burry says we're still high, and I'm sure you still want to hear more. But first, what's up, bulls? Are you wondering what the best stock to buy is? Maybe you're asking yourself what is the current situation of the global economy? Or just thinking about whether we're in a deep recession or not. Good for you, you're in the right channel, because that is what we discuss in Stockologist. If you're new, hit the like and subscribe button and let us start the discussions. 3 variables will make America's coming downfall worse than the recession. Michael Burry has nearly sold all his investments due to these 3 issues. First, inflation is set to soar. The Fed is resolute about raising interest rates to battle inflation. Federal Reserve Chairman Jerome Powell announced a 0.75% or basis point interest rate hike. Recent CPI declarations signal declining inflation. Disinflation is when inflation pauses momentarily. The Fed's rate hikes could be to blame for disinflation, Burry poses. He thinks humans create deflation. Burry outlined inflation peaks. Biden or Powell won't resolve this spike, because it's inflation essence it will be. It resolves, deceives, then backtracks. Neither the president nor the Fed will take credit. The tweet includes an S-era chart. The graph shows peak inflation years. After the first inflation spike, there's always a larger one. During the initial inflationary meltdown, the economy always falls. To stimulate the economy, the government restarts money printing. The government doesn't know that inflation will rise again. Money velocity theory explains why. Money velocity is the pace of economic transactions. Divide GDP by money supply to get this. Consider a pizza-only economy. Hypothetical year of pizza sales. If a slice of pizza costs $10, multiply 3,000 by $10 to find the GDP. Let's assume $10,000. Money velocity is $30,000 or $10,000. The average US dollars used in 3 transactions per year equals money velocity. Despite the growing money supply, money velocity hasn't accelerated until recently. Burry recommended velocity equals nominal GDP money supply. Increasing speeds are breaking through the narrative shroud. Rising velocity overcame falling money supply to boost inflation. Redux stance. The tweet includes a graph showing money velocity versus money supply. The white line shows the money velocity has grown from 2. This means fewer annual average dollar purchases than before. Money velocity has increased recently. If money velocity rises, inflation will worsen. Burry created a graph showing cyclical inflation. In the 1980s, inflation soared to over 15%. Burry said inflation has peaked. No peak exists. After deflation or disinflation, it returns. Some inflationary regimes have lasted decades. The graph showed annual GDP growth and CPI changes. CPI and GDP growth are related. Before falling with CPI, GDP often rises with it. In the following months, if prices fall, so will the economy. Even if the economy declines, some will be hit worse than others. Taxes can be progressive, regressive, or proportional. The federal income tax system is progressive since higher earnings pay more. Regressive taxes target the lower and middle classes disproportionately. Each person pays a proportionate share of their income in taxes. Inflation, a regressive tax, primarily affects the lower and middle classes. The top class has the most savings, which are invested in inflation-resistant stocks and real estate. The poor and middle class lack freedom since much of their wealth is spent on consumerism. As prices rise, poor and middle class incomes will fall. Burry said inflation is a regressive tax. Food prices have never risen so swiftly and far. When the economy falls in the following months, it will be the Federal Reserve's responsibility. Burry sarcastically said if an object collapses, its creator is not responsible. If not the Fed, the fiscal government keeps spending as the Fed cuts down. Biden constantly releases new spending bills. This will worsen inflation. Burry's comparison of sugar to infants is apt. A baby lacks sugar. Long-term, the baby will crave more sweets, worsening their health. This pattern describes government spending. They spent trillions, which benefited the economy briefly but triggered a crash. Increased money demand will cause a second inflationary wave. Inflation is a serious problem, but there may be a more significant hazard. White House redefined recession in 2022. Low unemployment justified it. Unemployment fell from 15% to 3%. The economy needs low rates. A flourishing economy has no layoffs. Incorrect. Lag indicator. Unemployment rate. A recession doesn't affect it immediately. Unemployment will rise despite being low. White-collar jobs were in demand. As pay for skilled labor soared, businesses began offering to telecommute. This graph illustrates white and blue-collar telecommuters as the virus spread, with 70% climbing. This is 4 times blue-collar workers, 14 to 19%. Burry thinks remote work fuels the employment bubble. Turning off webcams can reduce remote white-collar productivity. Duplication occurs. Inefficient workers may need numerous personnel for one job. Burry foresees doom. Explained. White-collar jobs are booming. Lengthier redundancy, longer job loss. Homework is caught. The employment decrease will be sharper as unemployment climbs. Burry argues that work-from-home jobs will remind us of the job bubble. Economic cycles make this important. Unemployed spend less. This is shown via circular flow. Good markets depend on factors. A market crash leads to another. The job crisis will hurt the economy. The margin is more important than unemployment. Margin is worse than an abrupt employment decline. Investors borrow margin to buy stocks. Theoretically, eliminating the margin is a fine risk idea. Consider a $50 margin loan. 60% portfolio growth equals $110. 60% portfolio decline reduces asset value. Indeed, negative $10 portfolio margin calls are harmless. Your portfolio's equity falls below the minimum, triggering a margin call. If the margin is called, deposit more money. If not, the broker will sell your holdings and charge you more. The downside margin is worse than the upside. Now is the giant margin bubble. Options and futures make the margin riskier. The outbreak boosted single stock option trading volumes. Options trading volume rose $1 million year over year. Stock options outweigh common shares. Increased stock and options trading. Trading futures is exponential. Volatility from alternative investments increases margin calls. When a broker responds to a margin call, asset prices decrease. Others get margin calls, lowering prices and costing more. Credit card debt exacerbates the issue. In 5 years, credit card debt reached $1 billion. Debt has grown due to many credit cards. Given Goldman Sachs' dishonesty, the credit card explosion isn't surprising. Burry warned. Goldman pushes. Goldman Sachs Apple Card. 25% were bad credit borrowers. Easy Apple Card approval. Goldman offers sub-660 credit card loans. Poor credit quality. I've lent to low-income people. Inflation damages the poor. Goldman will default soon. Unpaid debts expire after months. Goldman has a 2.93% charge-off rate. JP Morgan and BofA are 1.5%. Margin and credit card bubbles will crash the economy. Burry explained how options affect margin leverage. Futures skew the volatility index. Inflation skews consumer credit. Accurate quantitative tightening. Michael Burry says consumer credit, volatility, and margin leverage are worse. The Fed's quantitative tightening isn't as bad as it seems. Some may give a different story of the crash than Burry, but they are always wrong. They haven't considered debt as a solution to their difficulties. Burry asked, why are apocalypse predictions so unlikely debt-related? Real and nominal GDP versus U.S. public debt. Green line equals authentic U.S. GDP total U.S. public debt. This ratio has declined since the 1970s. The nominal GDP divided by U.S. debt shows the same. As U.S. debt rises faster than GDP, the GDP to debt ratio falls. More debt is created than economic value. Burry also added, no one can foresee consumer finance today. If it's easy to borrow, consumers will. We don't know how far credit cards, buy now pay later, stimulus moratoriums, and forgiveness go. The Fed agrees. Based on the 3 signs, Burry feels the impending disaster could be worse than the recession. Despite a considerable drop, the stock market is below recession levels. S&P 500 is 25% below its peak. During the 2008 recession, the S&P 500 fell 55%. Burry says the crash's cause is unknown. He explains, "We haven't hit bottom after failing look down. SPAC ETF failure is insufficient. Michael Burry gets fired for betting on REX. Despite predicting financial disasters, his record is nearly perfect. Burry's predictions: Bitcoin meltdown, meme crash, SPAC, inflation. All of these occurred, and now Burry sold all but one of his stocks due to his inflationary theses." And I guess that is the end of this video. Comment below what you think of our topic. Let's start a discussion in the comment section. If you liked this video, please like and subscribe. And don't forget to hit the notification bell. This will help us at Stocologist grow our channel even more. Thank you for watching, and we'll see you in the next one.